Good afternoon, and thank you for joining us for today's webinar discussing credit stress testing. A couple of items before we get started. We are in presentation mode, which means hopefully you can hear me, but I can't hear you, so certainly submit any questions throughout the broadcast, and we will take those either during the presentation or at the end. Secondly, we will send you tomorrow or the next day in an email a copy of today's recording along with the slide deck that we used for today's presentation. My name is Sean O'Brien, I'm the president of QwickRate, and as always, I'm pleased to be joined by Steve Huntington. Steve is the director of bank analytics and is really the primary architect of our credit stress test. For those of you who've spoken to him, he is incredibly knowledgeable not only about this, but our CECL tools, so we absolutely have the right person on the presentation today. We will touch on some of the additional features and tools that we've developed now with our new Intelli Credit offering that's headed up by David Ruffin and Larry Poole. They are not on the call today, so I'm going to take their portion as best I can. But suffice it to say, we hired credit experts to develop our Intelli Credit solution and are incredibly pleased with how that application has developed. So we're going to talk about stress testing. You know, stress testing always comes with a sense of confusion about what it is and what it isn't. So we'll touch on some of that. We'll talk about the different roles of stress tests, your options, and then Steve will take you through our tool as well. And at the end, we'll take any questions that might arise. So, you know, stress testing, there's a lot of conundrums, you know, of what it is and what it's not, right? It's not obviously a substitute for quality underwriting, but coming out of the last crisis, it became very important for regulators, for banks to know what is your capital cushion. They felt like if you read the autopsies of the failed banks from the last crisis, what the regulators became convinced of is there was a disconnect between the understanding of the level of risk that the bank had taken and what type of capital they had to survive any type of downturn. So first and foremost, what you know, regulators wanted, particularly community banks, to see and make sure their boards were aware of is what is that capital cushion, and you know, what type of cushion does a bank have through earnings, reserves, and capital to survive a downturn if it extended into 1, 2, or 3 years into the future. And so from that, you know, there isn't a regulatory prescription on what the right type of stress testing is. We think for most community banks, it starts with a portfolio level. Again, there's a little bit of, you know, how much work and time and effort and money do you want to spend, and, you know, to get an answer. And so this follows along one of our axioms, which is, you know, precision over accuracy, right? You know, let's not fool ourselves. But our stress test does an incredible job of giving you and identifying different levels of capital cushions that you would have. With the advent and onset of COVID, stress testing is becoming more of a topic again. You know, I think there was an expectation certainly last year that we'd see an earlier credit tail, which did not develop, but nevertheless, you know, it has become much more of a topic again amongst the regulators. And so again, it is a little bit of it, the beauty is in the eye of the beholder. So there's not one absolute right way to go about this, but we'll give you a way that we think is the most effective and efficient for community banks. As I mentioned, there's a lot of confusion around when you say stress test. It's often confused for maybe a liquidity stress test or an interest rate sensitivity test. You know, should it be a portfolio or loan level? You know, what in fact, you know, you have to do what the DFAST banks and the CCAR banks are doing. So again, what we're saying is, hey, what's best for your bank? We think typically that starts with a portfolio level test. Again, this can come at it from a lot of different ways. You know, it can be a top-down portfolio. It can be a bottom-up loan level. It can be scenario-driven. It can be sensitivity analysis, maybe as part of a loan review. Again, no one right answer. It's, you know, again, what you think and what you're looking for from the stress test. But again, if you look at it from the regulator's point of view, typically first and foremost, what they want identified and for all the participants to know is what's that capital cushion. So, our test that Steve's going to talk to you here about in a minute, we really come at it from three different ways. We show you three different tests, one based on peer groups, one based on your historical losses, and then we do a reverse stress test where we break the bank. Conceptually, these are the steps that we take to get you there. I won't spend a whole lot of time here, but essentially, again, we're doing a forecast over a 2-year period of time where we're forecasting income on behalf of the bank and then analyzing those three different scenarios over that same 2-year period of time, seeing what the capital implications are, see what the ALLL implications are, and then seeing what those pro forma capital ratios look like. Okay, so at this point, I am going to turn the presentation over to Steve, and he is going to walk you through our credit stress test. Steve?
Thank you, Sean. Good afternoon, everybody. Let me get my screen share up here. Give me just a moment. Let me know when that's popped up, Sean.
It has.
Okay, excellent. Give me just one moment. So the first thing that you'll notice when we pull up the credit stress testing tool on our interactive environment is that the entire stress test is actually run prior the second you log in, with some obviously some default assumptions built in. But the idea when we were designing this or redesigning it from this is sort of the second version of our credit stress test, and in a few minutes I'll get into what some of the specific enhancements and improvements we've made from the legacy version of our credit stress test for anyone who's on the call today who's seen our the older version of or the initial version of our credit stress test. Was that we wanted there to be actionable results pretty much right out of the box. And we wanted the only manual labor that's really required on your part is to modify some of the assumptions that we're going to walk through in just a minute here as necessary. And the benefit of being in this more real-time interactive environment is that you get to see the results of all those changes that we make to the inputs instantaneously, so that you can very quickly spot where the sensitivities of a tool are and what really is going to move the needle from an input-output standpoint. If you'll notice here, when we first pull up the tool, we're right in the executive summary of the results section, and we'll kind of come back to this executive summary, and these results once we've walked through what the inputs of a tool look like. So, and I'll also walk you through what each of the three tests are. As Sean sort of alluded to earlier, we run three completely separate and independent tests as part of the credit stress test. The first test is what we call the peer group loss experience. And that is where we're aggregating the loan loss histories of all the banks in your peer group, however you want to define your peer group. And if you've used QwickAnalytics before, or if you haven't, it's a very simple process to build custom peer groups. You can build as many different custom peer groups as you like. It's a very painless, 20 or 30-second process where you can very easily say, I want all the community banks in my state between $100 and $500 million in assets, or any other financial filters you'd like to put on that peer group. Or if you have a large hand-picked list of banks that you like to consider as your peer group, you can certainly do it from sort of a build-up method. But once you defined your peer group, we're going to go back in time and we're going to aggregate all of their loan loss experiences over a bunch of different historical time periods, over a recent healthy period, and then also during the meat of a last credit cycle when things didn't look so good. And we're going to take all of that peer historical experience and we're going to apply it to your loan portfolio going forward at the segment or category level. And so what we're trying to solve, we're trying to answer the basic question: if our loan portfolio were to perform going forward over the next couple of years like our peers did in these various different environments in the past, healthy, unhealthy, worst case scenario, what would be the pro forma impact on our P&L and our capital? So during this process, we are completely reprojecting your income statement going 2 years out into the future, as well as your capital levels and ratios going out 2 years into the future, assuming you were to perform, your portfolio were to perform like your peers has in different historical environments. Now, the second test is what we call the bank loss experience. It has all the same steps as the first test, all the same methodology. However, we forget about the peer experience and we look at your experience. How did you fare, not only during a recent healthy environment, but also during the last credit cycle? And in a worst case scenario, how bad have you ever fared from a loss perspective in each category or segment of loans? And then we're trying to answer a similar question. If we were to perform going forward like we did in these different environments in the past, what would be the impact on our earnings and our capital? And then finally, the third test, it's what they call a reverse stress test. It's what I fondly refer to as the how much rope do we have to hang ourselves with test. And that is, they call it a reverse stress test because it really does turn the methodology we just discussed from the first tests on its head and work backwards. Instead of reprojecting loan losses and using that to reproject earnings, and then using that to finally reproject our capital, as we do in these tests, we're starting at a specific capital level, like the minimum to be considered well capitalized or adequately capitalized, and working backwards to calculate what levels of losses would we have to sustain in our portfolio over the next couple of years for our capital to drop all the way down to these preset future thresholds. So again, it's why they call it a break the bank test. It lets you know exactly how bad things would have to get to break the bank. But before we walk through the outputs of these tests, let's go ahead and talk about the inputs for a few minutes. So there's a couple different sections of inputs. The first section is financial projections. Now, everything that's directly credit related, like loan loss provisions, gain or loss on sale of Oreo, those items we are going to reproject as part of the modeling. However, we need to get some sort of a baseline perspective or expectation from the bank, from the user, as to how they see the next couple of years going for things like, net interest income and fee income and overhead expense. So we do ask for some sort of conservative, middle of the road baseline projection inputs that we will that you'll see how they integrate into the tool as we move along here. We also ask you guys to help us with some customization of your loan portfolio. While we obviously have access to all the call report data, we want to make sure we properly modify those balances to make sure that we're not considering loans that aren't really at risk or we wouldn't be seeing losses on. So for example, PPP loans or COVID loans. This is the sample bank we're using today, for anyone who's curious, is a relatively large community bank up in New England. They have a $3 billion portfolio right now. They have $169 million in PPP loans. We know that from the call reports. Almost all the time, the PPP loans are sitting in C&I, right? However, the call reports don't really specify that. So we asked you to plug in exactly where in the portfolio the PPP loans are coming from. Again, usually that's the C&I portfolio. And then we asked you to help us in excluding any other government guaranteed type loans. If you have a large portfolio of SBA loans that has a large government guarantee, we're going to want to back the government guaranteed portion out as well, so we're not counting them from a charge-offs perspective and how it impacts capital. After the financial projections, there's a couple other assumptions. We'll come back to this in a few minutes, but these are some enhancements to the newer version of our stress test, where we allow you some customization in the reverse stress test, so you can plug in an internal target minimum for your capital ratios, and then we can calculate what losses it might take in your portfolio for your capital to drop to be sort of more internal thresholds. And then separately, we also allow you to plug in additional capital raises throughout the tool now. If you run an iteration of your stress test and it suggests that in a worst case scenario, your capital is lower than an internal target or a PCA threshold, obviously the logical questioning from a capital planning standpoint is going to be, all right, how much capital do I need to interject? What type of capital, and where and when? And so this allows you to sort of iterate the tool and plug in additional future capital raises and then see how that would impact the overall results. But again, we'll come back to these two assumptions in a couple minutes. The next section of inputs is around the peer data. So what we need to do about peer data, first, we need to define, again, what peer group we're using. By default, we just have your UBPR peer group plugged in here. We'll use that for today. but you can zoom in on your state and just pick, have this is another kind of semi-custom or semi-default, I guess, peer group. That's just all the community banks in your neck of the woods, and you can see how we define that here. Or you can pick any custom peer group you've built within the platform. I've obviously built lots of custom peer groups over my time using the platform on a daily basis. But for today, we'll just go ahead and click on the UBPR peer group. And then we need to define for the baseline scenario what the look back periods are. So in a baseline scenario, that's a healthy environment. We start by default by just looking at the last few quarters because, looking around the country at community banks, losses are still, pretty healthy and pretty baseline around the country. And it's very easy to change your look back period. We have a slider here. You can literally click on this and just drag it over and pick as many quarters or periods as you want to be included in your baseline or healthy period loss calculations for the peer group. But for now, we'll just stick with the last 4 quarters as they are. They look like they're pretty healthy, pretty baseline. And then we need to define the stress period. So when I click on the adverse stress scenario, by default, we use the years 2009, 10, and 11. Just doing a little statistical analysis, we wanted to get an idea before you customize it. What are some of the years that were the meat of the last credit cycle, right? Not only higher net charge-offs throughout the industry for most segments of loans, but also higher levels of reserves throughout the industry and higher levels of losses on sale of Oreo, which was a big piece of the overall credit loss picture during the last credit environment that we had. And you can see here, just looking at these 3 years and looking at the net charge-off ratio on the whole portfolio on average, these are definitely the right 3 years to be using. You might consider also for this particular peer group, including 2008, because losses were obviously elevated already by 2008, but losses came down significantly and were improving significantly by 2012 and 2013. So this is not a bad stress period to use, but once you build a custom peer group, what years were the worst during the last credit cycle for your peer group, you're going to want to choose those years as your look back period. And again, it's very easy to tweak that if you feel the need. Now, you'll notice over here, there's another column for percentile. And what that means is by default, we're not using, these aren't average or median net charge-off ratios in the adverse scenario. By default, they're 75th percentile loss rate, meaning what net charge-off ratio is worse than or higher than 75% of the banks in the peer group. The reason we've chosen it's not something we sort of picked out of thin air. That came from a lot of the early presentations done by the FDIC for larger institutions doing stress testing. They wanted to get a general sense in these adverse and severely adverse scenarios, not if you could perform as bad as your average peer did during the last credit cycle and survive. They wanted to see if you could perform worse than the majority of your peers did during the last credit cycle and survive. And so they sort of defined worse than most as 75th percentile for an adverse scenario and 90th percentile loss rates in the severely adverse scenario. So designed to be extremely punitive in the severely adverse scenario. That's why we default to the 90th percentile, but it's designed to be very, very worst case or even almost worse than a worst case scenario, honestly. But since those numbers are somewhat arbitrary, even though they've been given to us by the regulators over time, we wanted to make that an option to customize it. So if you thought that the adverse scenario was just too punitive and you wanted to see what median loss rates were for your peer group during that adverse scenario, all you have to do is plug in 50th percentile and everything just recalculated on the fly for all of your peers. And now we're looking at median values during the last credit cycle. And if you wanted to stress a particular segment of your portfolio more or less than the rest, you could say, listen, I want to use a 60th percentile loss rate for the entire portfolio, but just for the CRE, since I have a little bit of concentration there, my examiners seem to always be picking about it, I'm going to be a little bit more punitive on some of the non-farm, non-residential. So I'll take that and I'll make that 80th percentile, which is quite punitive for an adverse scenario. But as I plug in 80th percentile just for these two segments, everything recalculates. These all become 80th percentile values just for this particular segment. So that's how you can sort of customize it and be more or less punitive at the segment level or on the whole portfolio. Once we've sort of defined how punitive we want to be on the adverse scenario, we move over to the severely adverse scenario. The only difference between adverse and severely adverse is what loss peer percentile rank we're using. We're looking at the same peer group data. We're looking at the same look back period. We're just stressing it even more by taking each one of these values is not a 75th or a 50th percentile, it's a 90th percentile. So it's designed to be extremely punitive. And you can see at the 90th percentile, annual net charge-off ratios were 3, 4, 5% on the entire portfolio. OREO losses were 20, 30 basis points on assets, and reserve levels were 3 to 4%. So as you can see, obviously designed to be extremely punitive. Once we've gone through all of our peer-based inputs, the last thing we have to do from an input standpoint is just look at our own history. So we want to make sure that these last 4 quarters that we've chosen sort of as our look back period for a healthy scenario, if those really do reflect a healthy scenario. For this particular bank, the last 4 quarters, losses relatively negligible, OREO losses negligible, and reserve levels pretty stable, just over 1%. That looks like a good baseline period to use. And for the stress scenarios, I want to make sure that those years that we chose for the peer group were also your most stressful 3 years or 4 years. And if they weren't, you can customize this for your historical loss rate to make sure that we're looking at some of the worst years that you had on record, so that we can properly stress your historical loss scenario. Now that we have gone through all the inputs, let's start walking through what this looks like from an output standpoint. So if I go ahead and click over to test results, by the way, at any point, I can toggle between these two things. I can go back to the inputs, change one item, change how punitive a certain scenario is, and toggle right back over to the test results. And everything has already been recalculated on the fly the second I click back over to the test results. So before I look at the summary of the test results, let's go to the detail. So one of the other slides that Sean showed you just briefly a few minutes ago was that there is kind of 3 steps. After we have identified the peer scenarios and we know what loss levels our peers had in a healthy, an unhealthy, and a worst case scenario, we're going to apply those peer loss rates to our portfolio from a dollar perspective, so we can get an idea of what it means to us in real dollars. So here is the sample bank that we're using for today. Here's their loan portfolio as it stands today, current loan portfolio, and then we're applying annual loss rates from the peer group to come up with what net charge-offs we might see on our portfolio if it were performing loss rate wise like our peers did. So you can see in a baseline scenario, losses are very, very manageable, just a couple basis points. OREO losses are negligible, and reserves are at about 1.3%, because that's where the peer group is right now. In an adverse scenario, we have much higher losses to contend with. If our portfolio performed like our peers, we might see about 1.2% net charge-offs a year for 2 years going forward in an adverse scenario, and we might have $1 million worth of OREO losses, and we might be forced to keep a reserve of just over 2%. Now, in the worst case scenario, where every segment that we have is experiencing losses worse than 90% of our peers did during the worst credit cycle we have on record, so again, extremely punitive, we might see very, very elevated loss rates and net charge-off amounts, a very elevated OREO loss level, and an extremely elevated reserve level we would have to deal with. Now that we've sort of kind of got back to dollars and we know the actual net charge-offs and the actual reserve levels we might see going forward, if we perform like our peers, we can rebuild and reproject an income statement around those 3 different credit potential realities. So we have all 3 scenarios side by side, as we do everywhere, and we look at 2 years, year 1 and year 2. We have net interest income, fee income, overhead expense. These things are mostly coming from the inputs that we ask you guys to plug in on the front end, but they are affected by the credit environment to an extent, so we do make some modifications to net interest income as a result of increasing losses. But the big thing here is we have to project, obviously, when we're projecting earnings, what our loan loss provisions are going to be. And that's going to be 100% dependent upon what sort of credit environment we're in. So when you think about projecting loan loss provisions, it really has two components to it, at least the way I think of it. How much do I need to put in my provision for the actual net charge-offs, the losses that I expect to see, right? So that my reserve doesn't drop from where it is today. And then secondly, if my reserve is not currently high enough, if I need to get it to a higher level going forward, I not only need to provide for my charge-offs, I need to put even more in the provision to get that reserve up to a higher future level. And so when you add those two components together, you get a total loan loss provision expense. And that's exactly what we're doing in these three scenarios. The first part, provision to cover net losses. Well, this should match the actual net losses we expect. So these values here are what we just calculated on our projections. These are the net charge-offs by year that we just calculated on the previous page. And then secondly, we know that we need to get our reserves up to a higher level in these potentially punitive scenarios. And so in order to get our reserves up to 1.3%, 2.3%, 4% in the worst case scenario, we have to add more provision in to do that. Once we add that together, we get total projected provision expenses. We also then take into account any gain or loss on sale of OREO. So we look to your peers, we saw what levels of losses they saw during the last credit cycle, and we apply it to your OREO, to your balance sheet, and we project what losses you might see there. And we get pre-tax income. We tax it appropriately based upon your tax rates, or if you want to modify your tax rates, you can do that. And then we get projected net income in year 1 and year 2. Obviously, in a baseline scenario, pretty healthy net income. In an adverse scenario, these guys are still making a little bit of money, but not nearly as much. And in a severely adverse scenario, almost nobody's making money, right? The goal of the aptly color-coded blood red severely adverse scenarios is not to be making money. The goal here is to be surviving. So we need to see the impact on capital if we see losses like this. So that's the last step, right? Now that we projected earnings, reprojected earnings, we can look at our current capital levels and we can layer in those earnings or losses. We can layer in the dividends that we expect to see, which obviously will get pared back if we see if we start to see a more punitive credit environment, or suspended completely in an environment where we're losing money hand over fist. And then any other fun little RCR type adjustments that come from Basel III and whatnot, in order to properly reproject our capital levels going 2 years out into the future. And then we reproject the capital ratios. And this is really the end of the line for the stress test, for this particular test, right? We've reprojected our potential loan losses based upon peer experience. We've reused that to rebuild and reproject our earnings, and then reproject exactly where our capital would be 2 years out in all three scenarios of stress side by side. So if I go back to the summary, I'm going to see all the most important elements of what we just went through on one piece of, or on one screen. So we see here are our net losses, or our loan losses ramping up as the scenario gets more punitive. Resultant net income dropping down as the scenarios get more punitive. And then finally, current capital ratios and projected capital ratios, obviously declining in all three scenarios. And then we plot all those capital ratios so we can see exactly what happens from a visual standpoint. We can keep an eye on where that well-capitalized and adequately capitalized minimums are. And the goal here is that even in the worst case scenario, 2 years out, we still have enough capital to be considered well-capitalized or adequately capitalized. That's the goal of this type of a test. And that's exactly what this institution is able to just barely stay above well-capitalized in all four of their major risk-based capital ratios. And so now I'm going to hop over to the second test. It's going to go a lot quicker because, as I mentioned, all the same steps, all the same methodology. We're just using our historical loss rates as our guide and not our peers. So looking here, we're going to take our current portfolio and we're applying these historical loss rates. These are our historical loss rates in all three scenarios of stress. Apply it to our portfolio, recalculate what actual amounts of net charge-offs we might see going forward on an annual basis if we were to perform like we did in the past. Then we apply it to earnings, rebuild our earnings, our income levels. We can see earnings are dropping as the scenario gets worse, but not nearly as much. What does this suggest? Well, our losses during the last credit cycle obviously didn't come anywhere close to approaching our peers' losses. And so even if we were to perform as bad as we ever have, we could still earn a little bit of money in a worst case scenario. And then we applied to capital. So all the same 3 steps. And then we can look at the summary and see how it impacts our capital. So the third test, the reverse stress test, is a bit of a different animal, as I mentioned earlier. We're kind of working backwards here. So let's talk about what that means. Well, how much could we lose and stay well capitalized? It's a good theoretical question, sometimes hard to answer. And this is how we sort of we go about it. Well, first thing is, how do we define well capitalized? That depends if you are CBLR or not. If you have opted into CBLR, we have a different way that we go about the reverse stress test. Obviously, we're not solving for 4 minimums, right? If you're not CBLR and you have all your risk-based capital that you're still reporting, you have to reach stay above 5% leverage, 6.5 CET1, 8% total tier 1, and 10% total risk-based capital, right? You need to exceed all 4 of those minimums simultaneously to be considered well capitalized. So the first thing we have to do is figure out, if we were to start losing money hand over fist, which of these minimums would we breach first, right? Which of these is our bottleneck? And so the way that we calculate that, it's a lot of math behind the scenes, but we go through pretty much these entire stress tests and run it at different loss levels, iterate the entire tool over and over again until we find out which of these becomes a bottleneck. Once we know which one the bottleneck is, we can solve for it. What would it take for our bank to drop down to 10% total risk-based ratio from where it is today? Well, we would need to lose, or this of course sample bank would need to have net income losses of $176 million. Pre-tax, that would be almost $221 million. And of course, even in this hypothetical scenario where we're losing all this money, we still have revenue streams coming in, right? There's still some net interest income. There's still fee income coming in. So we have to take into account all those offsetting revenue streams. And once we do all that, we end up finding out that we would need to sustain net charge-offs and OREO losses of $400 million, which for this bank would be 12% of the portfolio. So they would need to have to charge off 12% of their portfolio over the next 2 years total, so 6% a year for 2 years, in order to no longer be well capitalized, in order to drop below 10% total risk-based ratio. Now, once they hit 10%, they're still well capitalized here and here and here, but that doesn't matter because they no longer have 10% total risk-based capital. So that's how we solve for that. Obviously, to solve for an adequately capitalized minimum, everything would have to be even worse. They'd have to sustain even higher losses to no longer be adequately capitalized. So you see now kind of how the reverse stress test works in that sort of opposite order. This is an enhancement to the tool we made in the second iteration of our credit stress test, based solely on user input. We had a lot of banks come to us and say, hey, we're very well capitalized. We've got 18% capital. These are not even good hypothetical scenarios, because we'd have to charge off 24% of the portfolio to not be well capitalized. And I can't even explain why we're doing that to the board, and the examiners don't even want to see that. But we do have our own set internal minimums, right? There are certain things we have to do if we drop below 14%, certain things we have to do if we drop below 12%. And we'd really like to be able to calculate exactly how much trouble we'd have to get into to drop below those internal minimums. So that's why we added that functionality into the tool. If I go back to the inputs, customize inputs, and I go to the other assumptions, I can plug in 12%. So let's say I want to solve for 12% total risk-based capital. Now I've plugged that in. I go back to the test results. I go back to the reverse stress test, and I click on the detail, and I see there's my 12%. So now I'm solving for this, and it means we would have to see losses of $300 million over 2 years in order to drop to 12%, exactly to 12% total risk-based ratio. So it just allows some more user flexibility in calculating some other reverse stress test minimum targets. And if I click on the summary of the reverse stress test, it just kind of has a nice little summary table showing this is the amount of losses you can see over 2 years total and still stay above your internal target, stay above well capitalized, stay above adequately capitalized, or the critically undercapitalized. So that's how the reverse stress test works. Now that we've kind of walked through each of the three tests, I just want to talk just a couple minutes about some of the administrative functions. There's a decent number of inputs that you can plug into running this type of a test. So you want to make sure that once you've got everything the way you want it, that you save everything as a scenario. So this is new functionality as well. I give it a scenario A as of 3/31/21, give it a date, and we can create as many, you can create as many scenarios as you want. As soon as you save one, it's saved securely on our servers. You can come up here and access it anytime you want to. If you've got 2 or 3 guys at the bank or women at the bank who would like to use the stress test and use this functionality, you can have as many users as you want on this. There's no limitation. There's no seat license or anything like that. And you can share these scenarios. You can create a more optimistic scenario, a more pessimistic scenario. You can build a scenario with a custom peer group that you use internally, and then separately build one that has a UBPR peer group, just in case you have an examiner who's being picky, who wants to see it with UBPR data. And once you've created your scenarios, obviously this interactive environment is great for what we're doing here today, right? We're tweaking inputs and assumptions. We're seeing we're seeing it recalculate on the fly, but you obviously want to present an entire output report to an auditor, to an examiner, to the board. So we allow you to export the results. You can either just choose an executive summary if it's something you're just kind of sharing with the board on a quarterly basis and don't feel like them getting too detailed into the weeds, or you can export the full report. If we do that to a PDF, it takes just a couple seconds and it crunches everything we've been through today. Don't fail me now. And it creates a PDF. So it's a full output report. Has a cover page, it has a methodology, it discusses the steps and the different tests that we run. It has executive summaries on the first 3 pages, and then it goes into the details. All of your assumptions are built into the output report, so anybody looking at this would know how you chose your peer group, any adjustments you made to the loan portfolio, what your baseline sort of run-of-the-mill projections look like before we take into account credit environment. We input, all the peer loss data going all the way back in time is integrated with the look back periods and credit and stress periods, very visually evident. And then we go through all the calculations. So everything is included in the PDF output of the report. You can also export it to Excel. The neat thing about the Excel export is that not only does it retains all the shading and spacing and formatting of the interactive environment, so it has readability, so to speak, even in the Excel environment. Let me open it up here just for a second so you could see that I'm being honest about what I suggest the tool does. So here, test 1 summary, test 2 summary, but it has all the projections in there, formatted, all the inputs that you plugged in. It gives you access to all of the peer loss data historically and all of your loss data historically in an Excel environment that you can do any further analysis that you want to. So one thing you'll notice throughout our entire platform, whether it's our stress test that we're talking about today, or any of the other tools that we have on QwickAnalytics, is that any way you want to get your data, it's one click away. If you want it as a PDF, if you want a PowerPoint, if you want it in Excel, if you want to pull data directly to Excel and not even log into the system, there's an entire environment for pulling all the data directly into Excel. So we made it a huge point when we first started designing our entire platform to make it very easy and uncomplicated and straightforward to get the data that you want, how you want, and when you want to get it. Now that I've walked through how the scenarios work and how the exporting works, we do have a user guide here, which we've just recently redeveloped. If you're using the tool 6 months from now and you don't remember everything we went through today on the call, we have a nice, organized visual user guide. We talk about each step to go through on the inputs, what to be thinking about as you're plugging your inputs, some best practice discussions down at the bottom, and it really walks through all the inputs and the outputs of the tool. So anyone who's going to be using this tool at your bank going forward should definitely have this as a handy resource. A couple pages from here might actually be good to share with the board if you are sharing the stress test on a regular basis, because it does a good job of summarizing what you're looking at and what it means and how you should integrate it into your overall capital and strategic planning process. We also have a nice little 1-page methodology guide, which is a good summary of how we run the test. And for anyone, again, who has used or seen our old stress test and wants kind of a summary of exactly what's new, although we went through it today, Again, it's our newer, more interactive environment, more flexibility and granularity on your look back periods and your financial data. New inputs on the reverse stress test and capital raise scenarios, and then the tool management features. But at this point, I think I've covered everything that we wanted to on the live demo. So I think I'll hand it back to Sean. Sean?
Okay. Thank you, Steve. So as Steve, mentioned, we not only put together that user guide for you. Steve, I don't know if you want to talk through any of these slides. These are really just a recap of what you showed. So we'll just kind of move on from here.
Yeah, I wanted to put them in there just to make sure, again, in case you have, I know you have access to you saw the live demo, but if you're looking at the PowerPoint presentation and we send that to you in the future, I did make screenshots of a lot of these just so you'd have it in the PDF of the presentation. So, but we went through this. I don't think we need to go slide. You can just very quickly kind of click through them and you'll see exactly what we've gone through in the live demo. Customizing the inputs, customizing the loan portfolio, the other assumptions we discussed, customizing the look back periods for your historical loss, customizing the peer data, and then next, reprojecting loans and losses and reprojecting earnings, and then finally reprojecting capital in all the scenarios.
Great. Yeah, exactly. So these are here, like Steve said, just so you have them. When we send the email with a follow-up, you'll have this along with today's recording. So, as we kind of wind down here, as we talk again about stress testing and just kind of bring it back to your situation, right? We just always think that the test should reflect the community bank. And so, again, with banks that have traditional portfolios, we think the portfolio test that we've developed, works exceedingly well. There's certainly times where you may get asked by a regulator, particularly in times of maybe, a fast-growing portfolio or an oversized piece of your portfolio for some, further analysis. But again, we don't think you need to push that hard until you're pushed to go there. These are some of the reasons why we've had banks say their regulators ask them to, do something additional. It could be a very high concentration. It could be loan losses well above your peers. Growing loans, quickly in a particular segment, or as you inch closer to being a more Dodd-Frank sized bank. But if you do decide and you prefer to do something a little bit more detailed, our Intelli Credit team can step in to help. For a lot of people, when they've thought about CECL or just even further stress testing, it often comes back to probabilities of default and loss given default. So while we're not going to go through this in great detail, what we want to assure you is that this is something that you're looking for. Our team at Intelli Credit, we can deliver on this type of stress testing as well. We can do a number of different scenario bottom-up, parameter-based stress tests. We can incorporate sensitivity stress tests. This is something we do commonly with our loan review, that as part of our external review, if you want us to stress a particular piece of the portfolio, we are happy to, companion that with loan review. For those of you who have not seen our Intelli Credit application, another area that you can look to and better identify if you need to do something maybe on an individual loan grouping or level, our Intelli Credit portal and portfolio analyzer will allow you to see, those different kinds of concentrations and subsets, or what might be a particular hotspot by a concentration or FFIEC code. We can look at risk-based capitals and just other ratios. You can see it, so you can again identify if there's something you need to look at further. Or a further portfolio subset, right? I think for a lot of banks and particularly examiners, NAICS codes and subsets by different types of loans is not only helpful in determining maybe loans for loan review, but it's also something, again, that you might want to individually stress test depending on the percentage of the portfolio. So again, that's part of one of the things that our analyzer does through Intelli Credit is help you just better identify and manage and have greater visibility and transparency into your own portfolio in a much easier way. And again, these are just a couple of other screens. Another piece that the Intelli Credit application allows you to see, since you are providing more loan level data on an ongoing basis in that application, you're able to see if your risk grades are migrating, right? That's another common area where banks are starting to do more, is instead of finding out and managing through problems that are already acknowledged and documented through the call report, by seeing your portfolio on a monthly basis, you can see and compare back historically, have our risk grades moved? Has our risk migrated? Or are we, is the bell curve of our portfolio still much the same way it's been over time? So again, it's just the old axiom: better information, better decisions. So that's really, again, there's a number of benefits we think the Intelli Credit application can deliver. We'd love to, demonstrate it for you at some point. But at the heart of it is moving from the portfolio level information we have available to you through QwickAnalytics, and now marrying that with the bottom up of your own idiosyncratic data that's only available through your core information. And so again, just more examples of the sensitivity stress test. So again, I don't want to spend a whole lot of time on this, but it is something, if you ever want a companion with loan review or a loan review quote, we're happy to provide that with you. So a couple things. One, certainly if you haven't been through your own data in QwickAnalytics, I encourage you to set up a time. Steve can walk you through it, or I can walk you through it. We'd welcome the opportunity to take you through your data. You can coordinate that with Ricky or Melissa or Pam, or our service team. Secondly, if you are interested in ever having a competing or a loan review quote, we'd welcome the opportunity to give you that. And again, any other additional information we can provide, whether it relates to CECL or just QwickAnalytics, we're certainly available here and be more than happy to take you through your data. So I'm going to check. I don't think we had any questions. Let's see. Nope, it does not appear that we have any. So I want to thank you all very much for joining us today. I hope you have a safe and happy 4th of July. We appreciate you taking time out of your busy day to join us. And please reach out to us if there's anything we can help with. So on behalf of Steve, I want to thank you again for your time, and have a great day. See ya.